Welcome back to Cheddar Business, everyone. Well, this week's stocks marking their worst start to the quarter since the financial crisis. The Dow down more than 800 points since Tuesday as more weak economic data and a new round of tariffs, this time on Europe, raise investor concerns. Joining us now is Jeff Weiner, CEO of Marcum accounting firm. Jeff, it's good to have you with us.
Morning, Kristen. Good to see you.
Yeah, so EU tariffs, right? Everything running the gamut from sweaters to wine and cheese. What do these tariffs on the EU mean for the market here?
Well, they certainly don't help. And again, additional tariffs are adding to the economic uncertainty, which is certainly undermining the stock market and most likely contributing to the 800-point drop the last couple of days.
Okay, so 800 points, but we also had a weak economic data, and then there was some talk yesterday that Elizabeth Warren, perhaps gaining steam in the election, also added to this drop. What are the other factors at play that drove the market down in the past 2 days?
Well, I'd say, economic weakness in general. Companies are holding back at this point. They don't know what's happening. They don't know what's happening with tariffs. People are concerned about the impeachment proceedings. They're concerned about who the ultimate Democratic candidate may be, whether they'll be business friendly or not, and none of this is good for the market. But you should know, when I was here in August, the market was down about 1,000 points from July. Last month in September, when I was here, it was back up to almost record territory, and now it's back down again. So we're seeing a trading range, and really the uncertainty is creating the volatility in the market.
How does the uncertainty in the market translate to the way that CFOs are planning for 2020 and how they're holding back on investment? Because if they do that, that could exacerbate not just recession fears, but actually make those things materialize because they stop spending money.
Oh, it actually becomes a self-fulfilling prophecy, because if people don't have confidence in the economic outlook, they're not going to make the long-term investments they otherwise would make if they felt that the economy was on track and they could rely on their forecast and expected profitability.
Look, the market's pricing in another rate cut at the end of this month in October, and then at least one more 25 basis point rate cut come January. Do you think that the Fed is warranted in making those moves, considering some of the weak data that we've had this week?
Whether they're warranted or not, I don't know that the rate cuts at this level are going to stimulate anything. Are they good for investor psyches? Maybe yes. Does it translate into people going out of fixed incomes into potentially equities because the returns on fixed incomes go down as rate cuts happen? Probably. But I don't know that it's going to affect the market overall.
You don't think that it would cause a rise in the market?
It could, but the tariffs, the trade wars, the impeachment proceedings all negate the positive impact of these rate cuts.
What about the jobs report tomorrow that we will get for the month of September? Look, you do not have a crystal ball, I understand that, but how does the weak manufacturing data, the weaker than expected data from ADP earlier this week, change how people may react to jobs numbers tomorrow?
Well, unemployment's been at historical lows. The weak job report could indicate that unemployment has bottomed out. Everything goes cyclically. So unemployment is going to bottom out at some point and start to rise. It's the same thing with the economy. We've been on an expansion since, depending on who you talk to, 2009, 2010. The economy goes in cycles again. The only question is, when does the slowdown start? How long does it last, and how deep does it go?
Okay, so we do have a manufacturing recession on our hands here in the U.S. after that read on Tuesday that sent the market down worse than 300 points on the Dow, right? 2 straight months of contraction in the manufacturing sector. At 10 a.m. Eastern time today, we're going to hear on the services sector. What are you seeing in the services part of this economy that could move the needle in terms of GDP growth and thus stocks?
We're not seeing a decline in services at this time. Right now, there's an unprecedented demand for professional services, whether it be legal services, accounting services, other services. But as the economy slows and as companies start to tighten their belts, they're going to reduce their reliance on outside professionals and either not do some work, not do some projects, or try and figure them out in-house, where in a good economy, when things are on fire, they wouldn't ordinarily look at what they're paying their outside professionals.
What are the most important numbers investors should be paying attention to in the fourth quarter?
Oh, that's interesting. I think the most important thing they should look at is not so much numbers, but stabilization. Numbers tend to follow events. So when things are not stable the way they are now, the numbers follow, whether it's a month later, whether it's 3 months later. I think The political climate has to stabilize, whatever that means. I think these trade wars have to come to an end. You know, everything is not scorched earth. This president seems to think dealing with our allies and enemies alike, everything is scorched earth. It really needs a more prudent, stable approach for the markets and small businesses to have the confidence and recover.
Do you think that the stock market can go higher from here, or that we are due for a pullback?
Oh, it certainly can go higher, but it needs the stability I was talking about in order to have a solid foundation to move forward.
What brings that stability, though? Because you talked about the volatility that just you've experienced in your visits to Cheddar. I mean, up, down, up.
Right.
What will bring stability?
I think it starts in the White House and comes out from there. But what's happening?
Can President Trump do that?
That's the big question. I'm not sure he's equipped to do that. But until there is some stability that emanates from the White House, I think we're going to see this market volatility. But you know, up and down 1 or 2% over the course of the month is not terrible. You know, we haven't seen, you know, the numbers are so big now, a 500-point drop, while it sounds like a lot of points, based on a 26,000 point Dow, is not as dramatic as it was in 1987.
So it's interesting because President Trump has tried to revive the manufacturing sector ever since he took office, right? Obviously, that's not working. How much of it is President Trump, and how much of it is just the changing nature of the job environment here in America?
It's probably a combination, but you know, the manufacturing jobs are changing. So you can have manufacturing jobs. Instead of coal jobs, you could have robotics jobs. Somebody's got to make these things, or technology jobs. So it's a matter of retraining the workforce. So a lot of it is talk, but you have to execute. You have to understand macroeconomics. You have to understand the people on the street, and then you have to go in and fix this little by little.
So you think stability out of the White House would be less back and forth about an impeachment inquiry or something like that?
Well, I think stability in general. You know, we have this saying in business that the fish thinks from the head down. And right now, the head of our country is not providing the stability that businesses and the markets need to go on about their day-to-day activity and prosper.
Jeff, we got to leave it there. That's Marcum CEO Jeff Weiner. Thanks for joining us.
Thanks for having me.